Tom Lee, a respected Wall Street investor and CNBC analyst from Fundstrat Capital, recently shared his thoughts on the market's potential recovery and Tesla's future. According to Lee, there's enough dry powder on the sidelines for a V-shaped stock market recovery, and he believes Tesla might be poised for a major upward move soon as Exhibit A for this huge move. He outlined why he thinks Tesla won't be canceled or significantly affected by its current brand crisis in the long run. Lee listed 5 key reasons why he remains optimistic about the electric car giant. He also emphasized that despite the challenges, he plans to keep Tesla in his fund. Lee's insight is definitely valuable, and he's even created a new fund, an ETF called 𝗗𝗟𝗏𝗧, which focuses on safe, high-probability stocks. Tesla is one of the major holdings in that fund, and Lee refers to it as a granny shot stock, comparing it to taking an easy, underhand shot in basketball, basically, focusing on the things that are most likely to succeed. He firmly believes Tesla will thrive once it moves past its current MyPillow moment, the brand crisis it's facing right now. If you only watch one video today, make sure you watch this one, all the way till the end. Hit the like button, let's get 1,000 likes on this one, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Today's video is sponsored by my good friends at Forecaster Terminal, the best stocks analysis software I use in finding these incredible stocks. More on that later. Let's listen to Tom Lee in his own words and hear what he has to say about this.
I'd like to zoom out because the market's been through a rough, turbulent period recently. And as you can see, the S&P at 5770 is roughly at the same level it was 8 months ago. In fact, the market actually has been arguably trading in a pretty wide range over the past 8 months. Now, that might raise some questions for you, such as, well, with this recent correction, does that mean stocks can stage a strong rebound? Or is there even fuel left for stocks to have upside? So let me just sort of point a few things out for you. If you look at money market cash balances at the end of July of last year was 6.1 trillion, and they're currently 7 trillion. So even though the S&P's been roughly at the same level, money market cash has risen by roughly $850 billion. That's a lot of dry powder on the sidelines, ready to buy stocks. If you look at margin debt, even though the S&P is at roughly the same level, margin debt has been declining recently, and we don't have the number for the end of March just yet. It's published monthly, but my guess is that it's come down a lot, so I don't think margin debt has risen significantly. Again, that means there's some dry powder there. And if you look at fundamental long-short positioning by hedge funds, this is data provided by a prime broker, you can see that the net long positioning is the lowest. It's much lower than it was a year ago, and really it's the lowest since before 2020. All of that to me looks like it's fuel for upside, especially for a market that's been stuck in a range. And I think it is fuel for a face ripper rally. Now, the pretext to this, and it's been something I mentioned last week, is that the stock market had a waterfall decline, the 5th fastest 10% decline ever since 1950 at least, and that those other 6 precedent declines of 10% in a similar time period were actually shocks to the market. They weren't the start of a major downturn. So when you think about stocks from their 52-week highs falling this fast, this qualifies as a shock. Now, the drivers for the shock are, of course, the tariff war, the risk that Doge will create a recession, and that's evident in the anxiety of consumers. This notion that there's no Trump put and no Fed put. So these are the reasons why markets lost faith over the past month or so. Now, last week we got a reminder that there was actually a Fed put with the FOMC rate decision. And as with regard to the tariff war, as you can tell, recently the rhetoric has been dialed back. And it looks like there will be some deals coming into place, but it won't be as drastic as many expected. In fact, it looks like Trump wants to make a deal. As for a Doge recession, that remains to be seen, but given how we've dialed back rhetoric around a tariff war, I wouldn't be surprised if there's going to be dialed back rhetoric around the severity of cuts around Doge. And then lastly, I think, and it's something we addressed last week, that there is a Trump put. And it's been evident by what's happening with Tesla stock. In fact, in our view, Tesla is Exhibit A for a face ripper. If Tesla can stage a V-shaped recovery, I think that that's a template for what the S&P can do. Now, for a little context, Tesla has fallen 50% from 488 in December to a low of around 220. And the reason for that is that Elon Musk has become quite controversial because of his role at Doge, so much so that some analysts are calling for Elon Musk to take a step back from Doge. Now, that's not something that the White House wants, because if Elon Musk leaves Doge and goes back to Tesla, that might be good for Tesla, but that would stall, I think, a lot of the efforts for Doge and the government finding cost savings. And so as a response, the White House obviously wants Elon Musk to stay, and part of that has to come with actually making sure Tesla stock actually stops falling. So that is the Trump put at play. In fact, I think that's why we're starting to see what looks like to be a V-shaped bounce in Tesla. Our technician, Mark Newton at Fundstrat, believes 330 is the key level to watch. That would confirm a V-shaped recovery is underway, and that would allow or set the stage for Tesla to make all-time highs again. So from a Tesla perspective, which is owned by the 𝗗𝗟𝗧 ETF, it makes sense to actually stand firm here, expecting Tesla to bounce strongly. Here are the 5 things that I believe represent the competitive strength of Tesla. And I'm going to walk you through it. The first is the strong brand and customer loyalty. I mean, it is synonymous with innovation, but this is exactly what is being questioned today. Historically, roughly 38% of Tesla buyers were Democratic. By 2024, though, that had really changed quite a lot because Democrats were fleeing the brand. So I think Tesla was already suffering from a shift away from buyers based on political affiliation. And President Trump, in just last week, actually talked about buying a Tesla and support the brand. I'm not sure that Tesla is going to be able to necessarily recover those Democratic leaning buyers, but I think it is strange that somehow Tesla has become a political brand. But there's other reasons to consider. Tesla has an enormous lead in full self-driving, robotics, and AI. That is not changing just because some folks are trying to cancel Tesla. They have a high-quality employee base and an innovative culture. Tesla attracts the smartest employees, the smartest candidates, because they are not only drawn to Elon Musk, but also to the success of the company. They have superior battery technology and a supply chain that is unmatched. And finally, they are really enormous lead in scale manufacturing. They're one of the few companies that makes money selling electric vehicles, and they have an extensive supercharging network. So if you ask me, is Tesla threatened by the PR nightmare that's happening currently? I don't think so. I think it is ultimately going to be short-term noise. And if you look at the stock price, Tesla has seen this before. The stock has gone through periods of consolidation and then made explosive moves. So it's possible Tesla right now is consolidating, but does that mean it's not going to do what it's done in the past, which is make an explosive move? I don't think so. So to us, we still view Tesla as a granny shot.
Okay, let's dive deep into an in-depth breakdown and dissect Tom Lee's latest market update. So he starts off by giving us an update on the Fundstrat 𝗗𝗟𝗧 ETF. He mentions its price, NAV, and total assets, but more importantly, he zooms out to look at the bigger picture. He points out that while the S&P 500 is sitting at around 5,770, it's essentially at the same level it was 8 months ago, and that's where the real questions come in. Are we gearing up for a rebound, or is there no fuel left in the tank? This is where Tom gets into some key indicators that suggest there's actually a lot of potential upside in the market. First, he talks about money market cash balances. Back in July of last year, we were looking at $6.1 trillion, but now it's up to $7 trillion. That's an $850 billion increase. Basically, a lot of money sitting on the sidelines waiting to be deployed. Then he talks about margin debt. He doesn't have the latest numbers, but based on trends, he's pretty confident that margin debt has actually decreased. Why does that matter? Because when margin debt is low, there's more room for investors to take on leverage and push the market higher. He also mentions hedge fund positioning. Apparently, net long positioning is at its lowest level since before 2020. What does that mean? Hedge funds have been extremely cautious, which could set the stage for a major rally once sentiment shifts. Now here's where it gets interesting. Tom argues that all of these factors, the high cash balances, the decline in margin debt, and low hedge fund positioning, are actually fuel for what he calls a face ripper rally. In other words, if the market finally breaks out of this range, it could do so aggressively. One of the key things he highlights is the recent sharp decline in the market. According to him, this was one of the fastest 10% drops in history, and historically, these kinds of drops tend to be market shocks rather than the start of a long-term downturn. So, if history repeats itself, we might actually see a strong recovery rather than a prolonged bear market. Tom then gets into what caused the market's recent drop in the first place. He mentions a few key factors. First, the uncertainty around tariffs has been weighing on investor sentiment, but recently the rhetoric has softened, and it looks like there may be some deals in the works. Second, he refers to concerns over a Doge recession, which remains to be seen, but again, with the tariff rhetoric cooling off, there's a chance that recession fears will also ease up. Third, at one point, the market was operating under the belief that there was no Fed put and no Trump put to save it. But last week, the Fed's actions suggested that there actually is support if things get too rough. That alone was enough to restore some confidence. Now this part is fascinating. Tom brings up Tesla as a prime example of how government influence can impact the market. He explains how Tesla had dropped from $480 to around $220, a massive 50% decline. A big reason for that drop? Elon Musk's involvement with Doge, which created a lot of controversy and uncertainty. But here's where things take a turn. Tom suggests that the White House doesn't want Musk to step away from Doge because it would hurt government efforts. So, in order to keep him there, they have an incentive to make sure Tesla stock doesn't collapse. That's what he refers to as the Trump put. If Tesla stages a V-shaped recovery, it could be a sign of what's to come for the broader market. Finally, Tom goes over some of the top-performing stocks in the Granny Shots ETF. The winners last week were 𝗣𝗟𝗦𝗧, Cadence Design Systems, Palantir, AMD, and Netflix. On the losing side, we had Garmin, Meta, NVIDIA, Progressive Corp, and Accenture. He also highlights three major investment themes. First, energy and cybersecurity. These sectors performed well, with stocks like 𝗣𝗟𝗦𝗧 and Palantir leading the way. Second, quality growth. Tom argues that quality growth stocks will benefit the most if there's a V-shaped recovery. And third, PMI recovery. Stocks tied to economic growth like Goldman Sachs, JP Morgan, and S&P Global could see major upside if the economy stabilizes. So what's the big takeaway from all of this? Tom Lee is pretty bullish. He sees a lot of cash on the sidelines, reduced leverage, and cautious hedge fund positioning as a setup for a major rally. He also thinks the recent market drop was more of a shock than a long-term trend, and with the Fed, the Trump put, and improving sentiment around tariffs, there's real potential for a face-ripper move higher. Whether you agree with him or not, his insights give us a lot to think about. Let me know what you guys think in the comments. Are we about to see a major rally, or is there more pain ahead? Share your thoughts in the comments below. Want to take your investing to the next level? Forecaster is the tool I trust to find incredible stocks like these. It also allows me to know in real time when politicians and company insiders are buying and selling stocks. Don't wait. Try it for free now. Use the link in the description and code Galore10 to get started. Don't forget to like and subscribe for more breakdowns like this. See you in the next one.